Now that we can prepare a basic balance sheet, we'll start to learn how to prepare a classified balance sheet. So pretend a business had the following balance sheet. I've got some assets on the left hand side, I've got my on the right hand or equity side, I've got my liabilities known as equity. That's good, but it doesn't answer some important questions such as which liabilities must be repaid first. Now if it's the tax debts, that's not such a big deal, but if it's the loan that's due first, or some of it, all of it, I don't know, I'm going to have to find $45,000, which is a lot of money. Secondly, which assets will become cash soon? So for instance, I'm going to be able to turn the inventory into cash quicker than property, yet I've got them listed in the same section in the asset side. Another question could be, will some assets be owned for many years, e.g. property? And has the business got enough money to pay its liabilities this month, this year, in 10 years, and so on? I can't answer any of those questions from just a regular balance sheet like that. So what I'm going to do is classify my balance sheet, and what that means is assets are classified into current, assets that will be turned into cash or used within the next 12 months. So things like cash, inventory, and accounts receivable. Then I'll divide assets into a second category, which is non-current assets, assets that the business will own beyond the next 12 months, things like property, vehicles, IT equipment, and so on. Likewise, I can classify the liabilities into current, debts that must be repaid within the next 12 months, so bills and expenses, e.g. the phone, power, wages, that sort of thing. Short-term loans and accounts payable or creditors. Also, tax bills is another one, so GST when we get to that. And I can also classify my liabilities into non-current debts that will be repaid after the next 12 months, e.g. long-term loans, mortgages, and so on. So, look, the reason why we need to do this, we'll look at it by way of an example. Who would you rather be out of these two businesses? They've both got assets of 100,000 and liabilities of 70. So we can't tell or make an informed decision as to which business is better or worse off at this point. But if we look at their current and non-current assets split, you'd look at that and say, I'd rather be business A at this point, given that it has more current assets than business B. However, what we'd also need to know is the current liabilities. How much is due in the next 12 months? So if I look at that, I'd probably prefer to be business B. It only has current assets of 20, but it also has current liabilities of only 10,000, whereas business A doesn't actually have enough current assets to cover its current liabilities. So in this case, we want to be able to classify the balance sheet here for Harry's Hats into current and non-current. So we take things like cash, current, inventory would be a current asset, property, that's non-current, accounts receivable or debtors is current, and vehicles are non-current. The loans, well, we've got two. One's due on 180 days, so that'll be current. One's due in 10 years, that'll be non-current. A mortgage is non-current. Accounts payable is a current liability. So as we go, we'll learn what is and isn't a current or non-current asset or liability. And what we'll do is we'll now set that balance sheet out in a much more informative structure. So we can see our current assets are 35 grand and our current liabilities are 115, and our current liabilities are 20,000 and our non-current liabilities are 70. So looking at this business, I can see that its current assets will adequately cover its current liabilities, and that will affect my decision making. So some answers such as questions I might have that require answers are which liabilities must be repaid first. So obviously I'm going to pay the loan that's due in 180 days rather than the one that's in 10 years, and the mortgage that's due probably 20, 30 years. Which assets will become cash soon? Well, everything but the property and the vehicle. Will some assets be owned for many years? Well, anything that's in the non-current section by definition will be owned for at least a year. And has the business got enough money to pay its liabilities this month and this year? Well, it looks like it does. And in 10 years, well, it seems to have more non-current assets than non-current liabilities. So I'd say that the answer to that is yes as well. Why are we doing this? Well, it fulfills the qualitative characteristic of relevance. So if we define that, information is relevant if it influences the decision making of the business. So going back to business A for a second, if we have this classified info, it helps us make decisions. For example, how will we finance our current liabilities? They're actually 60,000 and we've only got $50,000 of current assets. It's a really important decision. We might need to sell some of our non-current assets, or maybe the owner needs to provide additional capital. So if we get a theory question as to why we're classifying, it's all about relevance and being able to make decisions. Looking at this is just one last example we need to consider. The vehicle here for $15,000, what if the owner intends to sell it within 6 months? We've got it as a non-current asset that's not going to be consumed or used up or converted to cash in 12 months. If we are actually intending to sell it in 6, should we move it up to the current assets section? And the answer is no. Even if we do intend to sell it, we're never going to reclassify the car as a current asset. So why do we do that? Well, there's some assets that are always going to be non-current regardless of our intentions. So premises, vehicles, machinery, equipment, office equipment, computers, furniture, that sort of stuff. And the reason we're not going to reclassify them as current is because of the going concern principle. We're going to assume the life of the business is infinite and will last forever, and therefore we'll assume that these assets will be held for longer than the next 12 months. Even if they're not, we're going to make that assumption.